Good morning. This is Connor from Zero DTE Traders, and in this video, we'll cover the week ahead, highlighting upcoming events, the JP Morgan put caller trade, SPX and VIX charts, and volatility dynamics. Let's dive in. Attention this week will be centered on April 2nd, a date that U.S. President Donald Trump has referred to as Liberation Day. President Trump is expected to introduce reciprocal tariffs in addition to a 25% tariff on automobile imports. This week will also be packed with key economic data, particularly related to the labor market, JOLTS data, ADP, and ending with the highly anticipated non-farm payrolls report on Friday. The market regime, so looking at dealer positioning, dealer gamma remains negative 1.2 billion notional, trading below the transitions 5730 flip, 5750 zero gamma. This has been the regime for a good 5-6 weeks now. Bears in control. Now, when SPX is below that flip in negative gamma, we can expect higher volatility, reduced liquidity, weaker levels, and less predictable pinning action. That's important to know if you're a butterfly trader. Now, if we look at the SPX return distribution, we can see that visualized here. The zero gamma level to the left, negative gamma, to the right, positive gamma. And you can see the deeper that negative gamma, so the lower that gamma index, the wider that return distribution, and the higher that gamma index, the narrower the return distribution. And we're sitting in this range here, so we should most certainly expect a lot of volatility here this week. In terms of levels, we have a standout strike, 331 JP Morgan 5565 put strike. This is part of their put caller hedge for one of their large funds. As you can see, it is significant in terms of negative gamma. Now, in negative gamma, dealers sell weakness. They buy strength to hedge their position, which is why we see elevated volatility in negative gamma due to those hedging flows and reduced liquidity. So if we break materially below 5565 here today, dealers are going to have to sell to maintain delta neutral. However, if we do put in a low and the momentum starts to turn up, dealers will have to sell to maintain delta neutral. So there's potential for reversion back to 5565 today. Now, we are recording this pre-market, and we're down about 1% here, so we're most certainly below this. We're going to open below it as of now. Now, additionally, this trade is going to get rolled today. And this is about 40,000 contracts, and that roll is going to take place usually around 2 p.m. So the roll itself could be a trigger for large buy flows. So we want to watch for maybe some volatility around that time. It could be up, could be down. We don't want to be, blind in our assumptions here. We just want to be aware of the options dynamics and utilize our market timing signals to enter exit trades and, kind of look for a pivot around that time. Taking a look at the SPX on the 1 hour chart, we broke this bear flag on Friday, sharp down move, and we're seeing continuation here today. SPX set to open down about 0.9%. So we're clearly seeing an outside day, which is a trend continuation indication. Apart from 5565, that JP Morgan strike, we have a gap on the downside, which is about 5567 to 5522. So potential gap fill here today. And then, of course, gap fill reversals, always a potential setup, counter trend. So keep that in mind. Now, below that sits major support here, 5,500. This is the low of that corrective pullback. So pretty critical here. A break would imply continuation. Now, today, going into quarter end, 5565. 5,500 should provide some support for the markets. So we do look at that as potential lower bound here today, implied low, which sits at about 55.24, implied high up at 56.36. That is a 1.0% implied move. Now, as far as the upside goes, bulls have to reclaim that 55.65 handle, which opens the door to 5,600. And perhaps this downsloping structure here. So if we connect the high from last week, Wednesday high, Thursday high, we do have this downsloping structure starting to form. Not super significant, but it could act as resistance and, start to form a downtrend. We highlighted early last week the jump risk in volatility, given the discount in volatility, and that VIX was at a 3-week low going into two major vol events, April 2nd, tariff deadline, and April 4th, non-farm payrolls report. Now, these events could be the trigger to reset volatility lower, but until then, volatility is likely to remain somewhat bid. However, there is fuel now for a volatility crush post-event if the outcome is satisfactory for participants. So that vol crush is going to be very outcome dependent. As of now, options are pricing in a 1.3% move for April 2nd, 1.4% move for April 4th. This is probably a little low and likely going to see a tick higher as those events approach. As you can see here, volatility risk premium has returned to neutral. Now, technically, implied vol is above realized vol, but not to a significant extent, marking VRP as a neutral signal, giving no edge to option buyers or option sellers at this juncture. There is much more information in the week ahead newsletter that I'm covering in this video. This is this week's, so today's issue, covering option strategies, single options, how to adjust them, manage risk, as well as daily levels for today. So if you want to join the newsletter list, you can sign up at the link below. If you want to join the team, get access to our daily newsletter, our levels, our key metrics, our insights, our tools, our trade ideas, you name it, you can join the team at 0dtetraders.com. Best of luck out there this week.